Understanding your credit score is essential for managing your financial health. At its core, a credit score is a three-digit number that lenders use to determine how risky it might be to lend you money or extend credit. The higher your score, the more likely you are to qualify for loans, credit cards, or even favorable interest rates. But how exactly is this number calculated, and what can you do to improve it? Let's start by breaking down what a credit score is. In the United States, the most widely used credit scoring model is the FICO score, which ranges from 300 to 850. The score is based on information found in your credit report, which is a detailed record of your borrowing history maintained by the three major credit bureaus: Experian, Equifax, and TransUnion. Lenders, landlords, and even some employers may check your credit score to get a sense of your financial reliability. Your credit score is calculated using several key factors. The most significant component is your payment history, which accounts for about 35% of your score. This means consistently paying your bills on time is one of the best ways to maintain or improve your score. Just one missed payment can have a negative impact, especially if it's more than 30 days late. Next, your credit utilization ratio makes up around 30% of your score. This ratio compares the amount of credit you're using to your total available credit. For example, if you have a total credit limit of $10,000 and your balances add up to $3,000, your utilization ratio is 30%. Experts recommend keeping your utilization below 30%. The lower, the better. The length of your credit history is also important, accounting for about 15% of your score. The longer you've been using credit responsibly, the better. This is why it's generally a good idea to keep your oldest accounts open, even if you don't use them often. Credit mix and new credit inquiries each contribute about 10% to your score. Having a variety of credit types, such as credit cards, installment loans, and mortgages, can be beneficial. However, opening several new accounts in a short period can be a red flag to lenders and might temporarily lower your score. So, how can you improve your credit score? Start by reviewing your credit reports from all three bureaus. You're entitled to a free report from each bureau every year at annualcreditreport.com. Check for any errors, such as accounts that don't belong to you or incorrect payment information, and dispute them right away. Next, pay your bills on time, every time. Setting up automatic payments or reminders can help you stay on track. If you're behind on any accounts, try to bring them current as soon as possible. Work on reducing your credit card balances to lower your credit utilization ratio. If you can, pay your balances in full each month. Avoid closing old credit accounts, as this can shorten your credit history and increase your utilization ratio. Only apply for new credit when you really need it. Each new application results in a hard inquiry, which can knock a few points off your score, especially if you have several inquiries in a short span of time. Finally, diversify your credit if it makes sense for your financial situation. If you've only used credit cards, consider a small installment loan or a credit builder loan. Just make sure you can manage any new debt responsibly. Improving your credit score doesn't happen overnight, but with patience and consistent effort, you can make lasting improvements. A strong credit score opens doors to better financial opportunities, from lower interest rates to easier approval for rental housing and even job offers. By understanding how your score works and making smart financial decisions, you're investing in your future financial security.